All right. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
It's 10 a.m. Pacific on Friday, May 23rd, Friday before Memorial Day. So we're going to try and keep this one quick so that all you listeners can get updated, but also enjoy your short week next week. So jumping into things, it's been a pretty nasty week for asset prices. And it all kind of started off last Friday with the downgrade of the U.S. government by the last ratings agency.
The third domino to fall.
Yeah, last domino to fall. Moody's downgraded the U.S. to AA1 from AAA, and that outlook was based on the federal deficits widening, in their forecast to 9% of GDP in 2035 from 6.4% of GDP in 2024. Obviously, that's not a good forecast, and there's a lot of kind of financial analysis that goes into that and a lot of actuarial analysis regarding various government spending programs. But the interesting thing was the market opened on Monday, and there wasn't much to do about nothing, in terms of the yield market. If you looked at the 10-year U.S. Treasury yield on Friday, it closed at 4.48%, and then on Monday it actually rallied in price and was at 4.45%. But we started to get the shocks on Tuesday when the Japanese government had a really difficult 20-year auction. The 20-year auction that wasn't, I'm calling it, where it basically failed, had the worst coverage ratio since 2012, which is a long time ago, when Japanese rates were kind of in the doldrums. And we were joking about on the trading desk earlier this week, a lot of banks are looking for Japanese rates traders right now. Guys from the 90s and 80s are having to dust off their trading jackets because for about 10, 15 years there was nothing going on in Japanese rates. And, all those guys were retired, but I guess they're getting calls to people to try and understand this newfound volatility. And I think, jokes aside, the theme that I'm trying to kind of kick this podcast off with is, okay, investors and markets are starting to look around and say, okay, these deficits aren't sustainable. Japan has a debt to GDP of over 250%, depending on how you look at it. And how do you make these numbers work? And with the U.S. getting downgraded, and it's all connected together in global asset markets. And so you saw that move in the Japanese 20-year auction kind of precipitate a big move in the U.S. when we got the Big Beautiful Bill Act that was in discussion Wednesday and got passed in the night hours Wednesday night. That act is going to be a deficit increaser. Depending on who you ask, it's going to increase deficits by trillions of dollars, either single digit trillions or double digit trillions. And people are going to debate about that, but I think the point is the market looked at that and was like, what's going on here? And you saw that repricing in treasuries. So I'm just going to kick off the discussion of the week with what happened in the Treasury market. Then we'll talk equities. Then we'll talk commodities, which was the lone bright spot. But on Wednesday, you saw the U.S. 10-year Treasury close at 4.6%. Now it rallied on Thursday, and it rallies. It's rallying again, modestly, as we're recording this podcast. But I think the point is, okay, it got up to 4.6. Now it's come back to 4.5. So investors are concerned. So that's something you have to worry about as an investor is, and we've talked about this a lot. The CEO of DoubleLine, Jeffrey Gundlach, has talked about this a lot. Bill Campbell, the portfolio manager in charge of the Treasury team here at DoubleLine's, talked about this a lot. And it's just the fiscal unsustainability. And it's just something to watch out for, and it's something we're taking into account here at DoubleLine. So it was kind of a rough week in the bond market because of those moves. But with the U.S. ag down about 41 basis points. The government sector was down about 28 basis points. Mortgage-backed securities down about 64 basis points. Corporate bonds down about 0.5%. High yield bonds down about 0.5%. Bank loans were about flat. They were down about 5 bips, but with their limited interest rate exposure, they were pretty flat. It was all driven by spread duration or credit risk premiums, and emerging market bonds down about 0.5%. So nowhere really to hide in fixed income land this week, though at the front of the curve, you could still kind of hide out a little bit away from those interest rate moves. And that,
Clip your carry.
yep,
Clip your carry on the front.
clip your carry on the front. We've seen a little reversal, and I think as the market processes this bill, the Treasury Secretary was out there discussing it today, and I think that as the market processes it, things are going to, over time maybe reach an equilibrium. But I think that it is worth noting that the 30-year Treasury right now is trading at 503, and it really broke through that resistance level. 5% was a really strong support level I should recant. It broke through that support level at 5%, which has now maybe become a resistance level because it's closed above it 2 days, Wednesday and Thursday, and it looks like it's going to close above it today. As we sit here recording, it's at 503. Thursday it closed at 504, and Wednesday it closed at 509. So, I think that that's important to watch, where that 30-year Treasury ends up closing out trading, because I think that, and as investors think about like the term premium in the market, which is like the amount of risk compensation they're expecting to receive to hold these securities, with these fiscal deficits looking concerning, investors definitely are going to be expecting more of a term premium. And I think that's why you're seeing those higher rates on the long end of the U.S. Treasury curve, as we've been talking about for a long time here at DoubleLine. So kind of a rough week, but I think it's important to look at that stuff and stay attuned, and we'll be updating you next week as well.
I
Now,
want to add a little context to that
oh
real quick.
yeah,
Just looking at the 30-year, I mean, the move we had just this month alone was over 50 bips. But just for our listeners out there to, help remind how far we've come. I mean, post-COVID or in the depths of COVID, the 30-year was down at 1.2, 1.21. Actually, that touched a low on a closing level, 1.19. And here we are, many hundreds of basis points higher, as Dhall said, at 5.03. So this is a serious repricing that's been going on. This is why we've been recommending to be short this side of the curve. But it's a serious repricing that's happened. As you said, broke through that 5% level. That's significant. It was hard for it to push through. It tested that numerous times, and here it is holding.
yeah, I agree with you, Mr. Kimbrough. And we don't want to get too we don't want to get too flustered, but we want to just see the facts and observe them and see what's happening. And I think that the moves we're seeing are rational moves given the fiscal situation in the G7, let's say, because it's not like the United States is the only dirty shirt around here. Europe's not necessarily having stellar debt to GDP ratios, even though that like Germany's is maybe around 80%. Still, you got like in Southern Europe, you got some real dirty shirts down there. So there isn't necessarily a place to hide other than to be wary of, these longer end yields and manage that risk. Now, kind of moving on to equities. Equities was a pretty rough week in equity land. Let me refresh right here so you get the most up-to-date information. Yeah, I mean, this week, every sector of the S&P was in the red. So
It's pain.
yeah, it was a bit of a painful week. Consumer staples were the best performer, down 60 basis points. The big loser this week was energy, down 4%. And we'll talk a little bit about that when we talk about commodities. But, there's the speculators out there kind of worried about the OPEC Plus meeting this week. They think that maybe, when Trump visited the Middle East, he visited Saudi Arabia, he visited Qatar, the United Arab Emirates, that maybe he was trying to twist some arms into getting production up to keep oil prices in the 50 area. But we don't really know exactly what was said behind closed doors. We can say that WTI crude is trading at $61.50 right now, and perhaps the speculation is the Saudis are going to increase production this weekend to kind of maybe take a little market share from some OPEC
Mhm.
plus members that might have been, overproducing to try and make more revenue. So keep your eyes on that OPEC plus information, or we'll keep you up to date next week. But that's the reason I think energy got rocked so hard. And looking at some of these other sectors of the market, the darling tech was down 3%, consumer discretionary down 3%, financials down 3%. I will say on a month-to-date basis, all these sectors are still in the green. So you have to keep that in context. After the ferocious rallies we've seen, a little bit of a sell-off is perhaps expected. So I would
I mean, from the actual intraday low, the S&P is still up over 20% from where we were in early April. I mean, it's been a hell of a rally, hell of a snapback, and it can't just be a one-way train of recovery here. It's been some vol along the whole way, which it seems like volatility is what we should continue to expect.
Yeah, I agree with you. I mean, week to date, the S&P is down 2.44%, and month to date, it's still up 4.5%. So just keep that in context. Um, Moving on to the commodity area, I mean, the Bloomberg Commodity Index is actually up 1.7% on the week, and the best performing sector, no surprise, precious metals up 5.5%. Gold up 5.5% on the week. It's trading at $3,360 right now an ounce, a troy ounce. Copper actually rallied pretty nicely this week. Good old Dr. Copper up 5.4%, putting the industrial metal sector up 1.8%. So that's kind of an interesting development given the context of all that's happening. And we'll round out with Bitcoin. Bitcoin's sitting at 109,000, up 5.5%. So,
Hmm.
the crypto bulls definitely had a strong showing this week, though I do find it interesting that kind of Bitcoin's up 5.48% and gold was up 5.5%. Just something to observe there. So, that was the kind of roundup in the week. Hopefully, you gain some insight on the gyrations in the Treasury market and what's happening in markets this week.
So, that leads us into the macro very light calendar this week, heading into the holiday weekend and the long weekend. On Monday, we got the leading economic index for the month of April. It printed at -1% flat. It's actually one of the weakest prints we've seen in a while. It's weakest since March of 2023. Major contributors to this weak print were average consumer expectations for business conditions and the S&P 500 weakness back in the month of April. So that those both combined contribute about half the decline. But the index itself is still not suggesting a recession. We're in warning territory. It uses that 6-month annualized growth rate. It's now at -3.9. The threshold for recession call will be -4.1. So we'll continue to monitor this index and see what it's telling us. Moving ahead all the way to Thursday, we had initial jobless claims and continuing claims for the week ending May 17th and 10th, respectively. The initial claims, I mean, all these numbers in general, steady she drifts, maybe a little uptrend. The initial claims printed at 227K, barely below estimates in the prior. It brought the 4-week moving average up to 232K. It's kind of near where we were at the October highs. But the continuing claims number did come in above the 1.9 million watermark, 1.903 million. That was 21K above the estimates and 36K above the prior. This 4-week moving average did make a new local high. It's actually the highest since November of 2021. So it's not leaps and bounds higher than we've seen recently, but it's, with these uptrends resume, it's worth keeping an eye on. So we'll continue to monitor on those and report. And lastly, also on Thursday, we got the S&P Global U.S. PMI data for the month of May. This is prelim data. And I just want to say that this is the first data set that fully captures after we had called the 90-day tariff pause. Granted, we don't know how long that pause actually will be. But that was announced on May 12th between the U.S. and China, where both of us, tried to lower the heat a little bit. And if you think back, the last 3 weeks plus, we've been seeing risk assets rallying. And now about half that time we've had this tariff developments. This, maybe can help sentiment, at least in the short term. And this is going to be the first data set we have that actually captures it. This survey took place between May 12th and May 21st. And that tariff backup occurred on May 12th. So getting into the numbers here, the manufacturing and services numbers both printed at 52.3. Decent expansion. This kept the manufacturing expansion streak alive at 5 months. All in all, decent prints here. Both were beating, they beat estimates and they beat the prior. Going into the details, a little under the hood, the output growth, it actually improved for both manufacturing and services. The manufacturing was more notable as it had the sharpest pace of increases for new work. It's been for the last 15 months, the sharpest increase in new work growth. This order kind of growth improvement was noted to be driven by domestic demand. Exports have kind of tapered off. So that's, it's a decent month this month for that. On a sentiment basis, the sentiment for both services and manufacturing rebounded to a 4-month high. Not exactly groundbreaking. It's still a little more dour than it was throughout 2024, the average for 2024, but there is a little bit of softening noted due to some developments positively on the tariff front and the trade front, but everyone is still concerned with that. Employment on the employment front, after rising in March and April, both manufacturing and services were noted to have a small contraction in employment. And, two more things, actually. Inventories, this is not going to be a shocker, but inventories are noted to be for the inventories of inputs for manufacturers that rose at the sharpest pace in this 18-year survey. Everyone's been stockpiling ahead of tariffs, or they had been stockpiling ahead of tariffs, and here they are sitting on a large set of inputs. And lastly, prices. We are seeing a tick up in prices. This was the sharpest price rise we've seen since August of 2022 in this measure. The output prices, this is what they're out, service providers and manufacturers are charging. These rises were largely linked to tariffs and the rise of the cost of the inputs. So people are passing along higher prices per this report. All in all, these are starting to show some signs of inflation like we saw in COVID. So it's worth monitoring. But again, this is one set of survey data. And that wraps up the week. I know, short week of data here.
Yeah, quick week of data. Not much going on, but I think you gave a good overview. So let's just roll into what to look out for next week. We have that OPEC Plus meeting, so keep an eye on that. What else have we got, Kimbrough?
It's a much more busy week. On Tuesday, we start with a bunch of manufacturing data. We got durable goods orders, the transportation, and related metrics. The headline number is usually quite volatile, so don't try and focus on that too much. But the durables transportation is estimated to come in flat at 0.0, slight improvement from last month. So we'll see if we have any continued thawing in the manufacturing sector. Also on Tuesday, we get the S&P Core Logic. It's the home price appreciation numbers. The 20-city measure is estimated to come in at 30 bips versus a prior 40 bips. That would push the year-over-year figure up to 4.6%. Also on Tuesday, we have consumer confidence from the Conference Board for the month of May. This is estimated to come in at 87, an actual uptick in confidence. Again, maybe we'll start seeing a little bit of this flow through, but we don't know how the volatile trade negotiations are going to go. But confidence sitting near lows. We'll see how it responds. Moving forward to Wednesday, we get the FOMC meeting minutes releases. We'll get to pour over those and see if there's any color worth monitoring. On Thursday, we get the annualized GDP number, the second estimate for Q1. It's estimated to be unchanged from the initial estimate at negative 0.3%. Just to keep our eyes further down the line, we'll say Q2 is looking decent to start, but we'll see how that comes. Also on Thursday, we get initial jobless claims, continuing claims, initial projected to be at 229K. Again, steady she drifts. We'll see if the uptrend continues. Finally, on Friday, we get some pretty meaty data here. We get personal income and spending for the month of April. They're projected to come in at 0.3% and 0.2%, respectively. It's a bit of a calm down from last month, but we'll see what the details show. There's just estimates. And on Friday, we get the PCE data, indicating more disinflation from the estimates. We got the headline estimated to come in at 0.1%, actually both the headline and the core. This would bring the year-over-year number down for headline to 2.2%, and the core number would estimated to be remaining flat at 2.6. So still positive developments there. We'll see how that actually comes out in the real prints. And that wraps up what we have on deck for next week.
Yeah, definitely keep an eye on that PC information. I think that the market's clearly going to be looking at that because it's going to have some of that April information in it.
Hmm.
Though, the predictions at this point are usually pretty good because a lot of the inputs are known. And, that wraps it up for the week. We hope all of our listeners have a great Memorial Day weekend. And we also want to kind of, give respect to those that paid the ultimate sacrifice
Indeed.
with this Memorial Day holiday.
Yeah, thanks to all our listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine on our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. And thank you all and have a good weekend.
Yeah, thanks all. Stay safe out there.